beginning of the year, I think it's really important to focus on some foundational things. So again, as always, we are always focused on things that are either about growing profit, production, or personal growth, right? Beginning of the year, as I've said last week, is usually a time where end of the year, we take some reflection, we do some planning, we hopefully get some tools and systems in place. So today I want to focus on something that is probably one of the most foundational tools that is missing for a lot of us in our business. Anybody guess what that might be? What is one of the most fundamental tools that is necessary to operate a business that in this safe space we can acknowledge probably 85 to 90% of us in the real estate industry are operating without it?
P&L.
A plan.
Yes, P&L, right? So I want to talk about the P&L. I want to walk through the P&L. I want to hopefully dispel any misnomers that might exist, remove some anxiety around it, right? End of the day, it's a very, very simple tool, yet it's a very important and powerful tool, right? So I'm going to walk through a P&L and just go line by line and just kind of explain what it is, how we use it, and how we turn it into a tool that actually increases profitability, right? So one of the biggest mistakes, I think, and by the way, this is a self-employed challenge, not just a real estate agent challenge, right? End of the day, self-employed individuals, we have a lot more responsibilities, right? Oftentimes we're the butcher, the baker, the candlestick maker inside of our business. So we have to take care of a lot of things. We're customer service, we're marketing, we're lead generation, we're accounting, right? Which most of us are not necessarily wired naturally to focus on the accounting side of things, which is one of the reasons why it often slips through the cracks. Yet it is one of the most important tools we have. One of the mistakes I think we make is believing that a profit and loss statement is simply just the thing that we need in order to file taxes, right? Filing taxes is a necessary evil. Our profit and loss statement should be our financial dashboard, right? It is the place that we go to understand what levers we need to pull, what dials we need to turn in order to maximize the output of our business, right? Gary Keller always tells us we should start with the end in mind. We've also learned at KW, the purpose of business is to fund a perfect life. And if that is the case, in order to fund our perfect life, our business has to be profitable, right? Therefore, we should start with the end in mind, which is profitability, okay? So I'm going to do a screen share here, and we're going to walk through the keys to the P&L, what all the terms are, and how we actually use it in an effective way. All right, so here we go. Let's take a look at this. Number one, let's talk about terms. Okay, so cost of sale. Cost of sale is a very important thing in our business. Somebody unmute and tell me what cost of sale is. What is cost of sale in a real estate sales business?
Everything associated with getting into the property.
Okay, tell me more.
So like, I'm thinking of more of it like going into the purchasing of a property. So I guess cost of sales is like everything associated with your costs, as a realtor to, maximize that property, to market it, and for all your ancillary costs surrounding, if you have file folders, and every single piece of, everything that's, associated with what you have to spend, all your spending.
Got it.
Is that
Okay.
correct? Your own personal spending as relates to the cost of sales. Is that correct? Maybe
So
not.
it would be correct in many businesses. So in a lot of
Okay.
businesses, cost of sale is all those expenses that are included in the product that you sell can be considered cost of sale. Yet in real estate, the definition of cost of sale is any expense that only happens when you close a transaction. Okay, so it's any expense that happens only when you close a transaction. So the most common and obvious examples of this would be one, your split with your broker, your market center, your office, whatever the case may be. Right. So that revenue, you close on a transaction, you've got your GCI, your gross commission income, which is just the sale of the home, the price of the home times the commission rate. That's your GCI. Then your office takes a piece of that. That is cost of sale. If you have a team member who actually did the transaction, maybe it was a buyer's agent and they are on a split, the portion that goes to that agent is cost of sale. If you have a referral fee, that is a cost of sale, right? So by definition, it's an expense that only happens when you close a transaction. A couple of things that are important about that. Typical bookkeeper, CPA, they will tell you that you do not have to track cost of sale because you never touched the money. Therefore, the IRS doesn't care, right? The check comes into the broker. The broker pays you your portion. They hold on to the other portion. If you have a team member, the broker distributes those funds. You only touch the part that you get to keep. Therefore, from the perspective of the IRS and many CPAs, that number is irrelevant. You never touch the money. You don't have to track it. However, it's actually a very important metric for a couple of reasons. Number one, if you are in fact operating a team, that is one of the number one areas where you can build a large team that is not profitable, right? So oftentimes, especially in the early days of building a team, maybe we're not very clear and or confident in what our value proposition is, right? And in the absence of value, everything becomes a cost conversation. In order to attract people to our team, maybe we provide very favorable splits. But then we fast forward and we've got a team that's productive and we look up and go, I don't understand what's happening. We're doing plenty of production, but nothing's making it to the bottom line. If I'm in a coaching relationship and this is the problem, one of the first things I'm going to look at is cost of sale, right? There is a high likelihood that part of the challenge is maybe we have unfavorable splits and that's squeezing our margins. So cost of sale becomes important there. Another example, we had a client recently with RE Profit looking at the budget with a profit assistant and noticed that their cost of sale was extremely high. Asked the question, like, why is my cost of sale so high? This particular agent had a referral-based business, right? So they've done a really good job of networking within the KW ecosystem. So they go to the events, the training, they meet people, they build relationships, all those things. So they get a lot of agent referrals, which is phenomenal. And the flip side of that is because their business was so heavy with agent referrals, there were referral fees attached to a lot of their transactions, right? And that inflates the cost of sale and lowers the margin. Now, the answer to that is not, well, I'm not going to take these referrals anymore. Of course, we want the referral business. But what came out of the conversation is that particular agent spending 2024 focusing on making sure they're maximizing their own database so that they can get as many transactions out of that database as possible. Those transactions don't have referral fees attached. Throughout the year, they were able to lower their cost of sale as a percent of GCI, increase their profitability. Does that make sense?
Mm-hmm.
Right? So this is an example of A, why the number matters, and B, how we look at a profit and loss statement and we use it to tweak our strategies and our approach so that we can maximize our profitability. Okay, so that's that. Gross profit on this P&L. So again, gross commission income comes in, broker takes their portion, you receive your commission. That GCI minus cost of sale is your gross profit, or gross revenue would be another way to say it. It's the money you actually get your hands on. Next comes our expenses, self-explanatory. Expenses is just the money that we spend, and what's left is our profit, right? So you've got GCI, cost of sale comes out, then you have your gross revenue, minus your expenses, you have your net profit, okay? Profit and loss statement is nothing more complicated than that. For all the numbers that we see on a profit and loss statement, as intimidating as it can be if we're not used to it, it is nothing more than addition and subtraction. It is what did we make, what did we spend, and what is left over, right? If we keep it that simple, it becomes a lot easier to get comfortable with it, okay? The other thing I want to point out with the profit and loss, in order for it to be effective in operating your business, you really need two things. You need the profit and loss, and then you need a budget. Okay, profit and loss is what I've done. Budget is what I should be doing. When you have both of those metrics, financially, It becomes very simple. When you look at your P&L, you just look for gaps. And when you identify a gap, you work to close the gap. Right? So if I know in this example, for the P&L we're looking at, we have a budget set at 5 million. So when we select that, it's creating a budget based on the MREA, the Millionaire Real Estate Agent Budget models, so that we now have something to compare what we're doing to, that we know if we match, we're going to maximize our profitability. Okay. The budget model within the MREA, at its simplest form, this is what it looks like. It is a 30, 30, 40 model. Somebody tell me what 30, 30, 40 is.
It's all of your expenses and your total cost of sale. And then your 40% is what you take home, your net income.
You nailed it. Great job. So 30 is cost of sale. 30% of your revenue is typically going to go to cost of sale. 30% is going to go towards expenses, and 40% is what's left as a profit margin. Okay. In case you are wondering, a 40% profit margin in business is like the Godzilla of profit margins. That is a massive, massive, massive profit margin, right? Sometimes I've sat with individuals who, when they hear these numbers for the first time, they're like, wow, we only get to keep 40% of our income. That is a massive profit margin in business. Okay. That being said, if you are an individual agent, it is possible for you to operate at a higher profit margin than 40%, right? Predominantly for two reasons. Number one, the majority of the folks here are Keller Williams agents. We may also have some guests here, but if you are a KW agent, that means you have a cap. There is a maximum amount of money that you can pay the broker in a given year. And once you get past that, you're receiving 100% of your commission. Because of that, your cost of sale can be significantly less than 30% if you don't have any team members and you're not really, really heavy on agent referrals. Okay. So one, as an individual agent, your cost of sale, once you hit capping status and keep producing, can start to become a smaller percentage, which then generates more profitability, allows you to keep more of the cash. Okay. Secondarily, expenses, depending on the type of business that you run, what your lead generation strategies are, where you invest, all of those things, it is possible that you may operate at lower than 30% on your expenses because you have less overhead. Once we go to that route of starting to build out a team, we have more overhead, more things we have to pay for. But generally, a good rule of thumb is 30, 30, 40. If I'm keeping my expenses in that 30% range, I'm keeping my cost of sale 30% or less. That leaves me with a 40% plus profit margin. On the other side of that coin, large teams. Large teams are predominantly operating at a lower margin, right? So a highly functioning large team might be at 25% profit. A large team, okay? That doesn't mean they're making less money. It just means they have a lower margin, which tends to be the case in business. As things get bigger and they scale, you tend to have a lower margin. That doesn't mean less money. It means smaller piece of bigger pie. Does that make sense? Okay. But if you keep that 30-30 model in your head, it gives you a benchmark to follow. Whatever platform you're using for your profiting, your profit and loss, and your budgeting, you should be able to see these things next to each other. So if you're using a CPA, if you're using QuickBooks, whatever it is you're using, you want to work with them to set you up so that when you're looking at your P&L, you're looking at your income next to what your income should be based on your production goal. You're looking at your expenses, actual, next to what they should be based on your production goal. Whenever you see a gap, that's where we analyze to say, what would I have to do in order to close that gap? Okay. Couple little nuggets on the gap piece. Where would be some examples that if we were over on an expense, it would require a little more analysis to decide whether or not that's a problem or whether or not that's actually okay. So we're looking at our expenses. If I scroll down on the P&L here, right? This is what you call a chart of accounts. Chart of accounts is just the buckets. It's all it is. It's the buckets of expenses that we put everything in. Okay. This follows the Millionaire Real Estate Agent chart of accounts, which I believe it's page 157. If you go there, that's where your budget models are in the MREA. But these are just your expense categories. That's all a chart of accounts is. It's your expense categories. Okay. Everything you do inside of your sales business should fit in one of these buckets. And inside of any of these buckets, you can have subcategories to get more specific as far as how you categorize. But everything should be able to fit in one of these primary buckets. Okay. But what's an example of an expense that we might be over budget on? And if we see that, we wouldn't go straight to cutting the cost. Joan, I saw you put your hand up.
Oh, not go to cutting the cost. Okay, lead generation, I thought, and communication, potentially like social media communication, if you're doing sponsored ads, looking at what your return on investment is on those. But you're saying if you're over, is that what you're saying?
Yes.
Yeah.
So
Okay, so that makes sense. Yeah.
you went right where I wanted you to go. And you
Okay.
even got to the bonus part of it. That
Okay.
is an
Good.
example. If you look at your lead gen, and maybe you're over budget on your lead generation.
Mhm.
That is an area where you would say, okay, I'm over budget. Am I going to cut the cost? Well, before I do that, let me see what my return on investment is for the things that I'm paying for. Right. So when it comes to marketing and lead gen, those are all expenses that for every dollar we spend, it should be generating new income for us. Right. The challenge we have is if we're not tracking the return on investment, then we don't know the answer to the question. Right. Without tracking that number, what we do is we tend to go on what it feels like. Okay. So I invest in some internet lead gen tool. Right? There's a million of them out there. You pick one. Then we tend to judge how well it's working based on how many leads we're getting. Right? So if you ask somebody, hey, I know you invested in XYZ. How's that going for you? Well, it's pretty good. What's your ROI on it? Well, I'm not really sure, but I'm getting leads. Awesome. Are you closing the leads? I mean, I got some good leads. Great. What's your ROI? Right? Until you know that answer, a really good example. Years ago, and I won't use names, but there was a very popular real estate platform where we all put our listings, and you could pay as a broker to enhance the listings on that platform. And all of a sudden, the reps for this platform were reaching out to all the brokers, very excited to introduce their new fee model. The long story short is the cost of the platform was going up about tenfold. And these reps were flying out to meet with all the brokers so that they could explain to us why we would want to pay 10 times what we used to pay for the same thing. That became a very simple conversation. Show me the ROI. The response was, here's all the leads we've provided to your agents. To which I responded, that is outstanding. What I need to know is how much money my agents put in their pockets. Because if it is not greater than what you're asking me to spend, then we are done doing business. Challenge is they couldn't answer the question because they didn't know the answer, which led to us no longer using the platform, right? Because at the end of the day, it's not about how many leads that it generates. It's how many closings, what did it cost me, what did I make, and is that a healthy ROI, right? If we track that number, then we are always able to go back and look and say, okay, what's working, what's not working, what do we need to keep, what do we need to cut, and if I want to grow my business, where do I reinvest in order to grow my business? Make sense? Okay. Karina, I see you have your hand up.
Yes. I'm kind of happy to see that on your education and dues, you're over budget. Historically, I'm always over budget. Is that pretty normal?
It is. Yeah. So this is one of those things, and I'm really glad you brought that up. So there's two things I want to say about that. Number one, the budgeting guidelines that we get from KW, they're exactly that. They're guidelines. My advice, my input is you should set your budget based on those guidelines. And if you are outside of them, it becomes your responsibility as a business owner to be able to justify those in an intelligent way. Again, like we just did with marketing and lead gen. If I'm over, I should be able to go to my return on investment tracking and say, okay, yes, I am over in this. However, I'm getting a healthy return on everything that I am spending. And therefore, if I was to cut it, I would actually make less money. So I'm not going to do that. I'm now making an informed and intelligent business decision to spend that money. Dues and education is one of the ones that most Keller Williams agents are over budget on. And I've actually had this conversation with KWRI a couple of times over the years. The budgets that you see on the screen right now are based on the models that they provide us, right? So they tell us at every level of production, this is the range at which the percent of your income you should be spending on each thing. However, if you are investing in your own growth, you're going to family reunion, you're going to mega camp, maybe you have a MAPS coach, all of those things, you are going to be over budget. So that is one area where, yes, the agents that I see who are very plugged in, very engaged in training and education, they're going to the events, they're learning, doing all those things, tend to be over budget there. That is probably the number one bucket where I see people over budget. Now, the key there is to just hold it accountable. Am I over budget because I'm engaging in training? And if so, am I implementing the training that I'm going and getting? Am I just being a tourist? Am I just going to have a good time and listen and hang out with my peers? Or am I learning things and then going back and implementing those things? If so, I would argue training and education is one of the areas where we get the greatest ROI. I would argue people, right? Growing ourselves, bringing other people into our world and growing them are the two biggest returns on investment when we do it correctly. So short answer, Karina, yes, that is one of the buckets that we very often see people over budget, especially within the KW model, because a lot of us who are really committed and engaged to our business, we are investing in those things. Family reunion, mega camp, we're going to regional events, we have a MAPS coach, all of those different things. Joan?
Yeah, I was just curious if there was a rule of thumb for education, like based on how many years you've been in or what GCI you're at for education, like, because that could change, like the recommended amount that you spend towards education. It might be heavily weighted towards the beginning years and less so in middle years when you're GCI and you're picking up momentum. I was just curious if there's any kind of rule of thumb on spending there. But I'm sure it's not like the same amount for every level of an agent.
Yeah. So I can't necessarily say there's a rule of thumb, but this is the advice I would give. If you go to KW Connect, they have our training sort of broken up based on the stages of your career. That should be your guide as far as what you should be leaning into, right? One of the biggest opportunities and challenges that we have is we have so many opportunities for training and education, right? I often joke that your biggest risk at KW is you can become the smartest, brokest realtor on the planet. Because if you chose to, you could go to training all day, every day, right? So my advice there would be this, depending on where you are in your career, on KW Connect, kind of follow the way they have our training broken down, right? For a new agent, it's things like Ignite early on, which generally is going to be something offered by your market center for free, right? Then it's win with buyers, win with sellers. That is generally going to be offered by your market center for free, or maybe it's being offered on a regional level at a pretty low cost to be able to attend, right? Then you start going into things like, well, value squared, I would recommend for everybody, which again, is typically going to be delivered on a local or regional level at little to no cost. Then you start getting into things like the personal development part of it, right? Because we always say your business grows to the extent that you do. That would be your quantum leap. That would be career visioning, right? When you get to the point where you're going to start looking to bring human capital into your business for leverage. That would be your career visioning. Career visioning is all about how do I identify talent, attract talent, train them, motivate them, and keep them. And then you've got your mega camp and your family reunion. So what I would always suggest is when you do your business planning at the end of the year, part of that should be your growth plan. Based on the strategies, the things that I am focused on implementing into my business this year, what are the trainings I need to go to? When are they and what are they? And what is the cost? So that I can build out that budget, right? I'll give you an example and then Alan, I'll come to you. I have an agent in my office who runs a very, very large team. One of the top teams in the KW system. There was a period in time where he looked up and he said, the thing I need more than anything is to hone my skills at attracting talent, right? He had a stage in his career where he said, I know how to sell houses. I need to learn how to attract and keep talent so that I can grow my team and I can move from me to we. That year, his commitment was the only training he was taking was career visioning. He picked the 4 instructors that he wanted to attend career visioning, being taught by those 4 instructors. He committed to fly wherever he needed to go in order to take career visioning 4 times in 1 year from those 4 instructors. And during that year, if you walked into my market center, there was a 70% chance you would see that agent in one of the boardrooms at a whiteboard with a victim in front of him. He was doing career visioning. I mean, I'm not kidding. 70% chance you walked in, he was in the boardroom, there was a victim in front of him, and he was at the whiteboard. That year became a pivotal year for him. His team blew up the year after. And if you weren't watching closely, right, it might have just looked like, oh my gosh, what an explosion of business, but it was very purposeful. At the beginning of the year, he decided where he was, what his business really needed, how he needed to grow in order to be able to execute that. And then he got really purposeful about the training and education. And he did have to put on the blinders and ignore some of their stuff, which is okay. Alan, you probably have some good feedback on that question.
Well, thank you. I'll talk briefly here. Just to mention that on page 157 in MREA, it does give a chart. It's the budget model. It does give a chart of targets, expense targets per category, and education varies based upon production level, but it's around 1%. You think, wow, that doesn't sound like much, but as your production increases, 1% of a bigger number is more than 1% of a smaller number. So, it's about a 1% kind of thing. By the way, of company dollar. Of GCI. So we just have to be careful when we look at these percentages. Are we talking about company dollar or GCI? But page 157 in MREA lists all those things. And I'll just say one other very quick thing, and that is really the top 3 categories of expenses are salaries, lead gen, and occupancy. After that, they all kind of flow into around, candidly 1%. And so when we think, and my answer to your question, Matt, is, what are the other areas? Salaries and benefits are the leader, or is the leader of the categories. And that's around, the good area for salaries as a percent of company dollar is, in the 18 to 23% range, which includes any bonuses or overrides.
Correct.
And so that's where, we can really do some things relative to looking at it. And then I said that was the last thing, but I lied. I had one more last thing, and that is return on investment. The guideline is 3 to 4 times any expense that we make or investment that we make in the business. We should get a 3 to 4 times return on that. If I spend 20 grand for part-time admin, I want to see the ability for me to get back 60 to 80 in GCI because my time has been freed up to do more lead generation. I've leveraged through that expense. So I don't expect the part-time admin to generate leads, but they're going to do things that I'm doing now, which prevents me from doing more lead generation. Now they're doing it, so I can pick up additional GCI.
Exactly. And the most important thing, or I shouldn't say the most important thing, yet a really important thing that Alan just said. I would agree the other bucket, marketing and lead gen, and then salaries and benefits. Those are your areas where you get the biggest return. Again, what did I say? People capital is where you get the best return when you hire the right people. However, when you're talking about hiring administrative support, what's really going to determine your ROI is, yes, the quality of the individual, your ability to give them the right tasks to do, right, to get things off of your plate. And then third, you actually reinvesting that time appropriately, right? If you get an admin and you buy back 30-40% of your time because you now don't have to do those tasks and you go golfing, unless you're picking up listings on the golf course, you're not going to get a very good ROI. You just have more time, but you're not reinvesting the time, right? So that's where it becomes really important that when you leverage those tasks away, again, we've talked a bunch. At the end of the day, building a business is really, at its simplest form, it is just slicing off the least dollar productive activities in order and leveraging them away to a system or a human. And each time I do that, I get more time back to reinvest into more dollar productive activities. And as I do that, I'm able to A, be more productive with my business time, and B, gain more balance in my personal life. But if we're not investing a good chunk of that time back into the business, then we're not going to see the ROI, right? We're just going to find ourselves with white space, right? What other questions or comments do we have at this point?
Hello.
Someone asked about occupancy fees, what they entail.
So for us, that is typically going to be like desk rental, right? So if you rent a private office or a cube, that would be your occupancy. If you have your own office, right? So we have a mega agent model inside our system. If you have your own location, that would be occupancy. If you rent a cube, private office, anything like that, those would all be occupancy costs, right? We have the benefit in our business that typically our broker is providing that to us at scale. And if we have a cost, it's a minor cost. We're renting or leasing a small portion of the space that's made available. Joan?
Yeah, I had a question regarding educational expense, which is regarding Bold. I've never been to Bold myself, and I was wondering if what you think about Bold in terms of return on investment. Is it better for somebody that's brand new or somebody that's been, doing business for 3 to 5 years?
Sure. Yep. I think Bold is phenomenal. I think the return on investment you get depends on how you play. Okay, so the biggest thing about Bold and what makes Bold effective, Bold spends a lot of time working on the 6 inches between our ears, which is where we have most of our challenges. Let's be honest. Most things in life aren't that complicated. We just make them complicated. What's really powerful about Bold is if you play all in, they spend a fair amount of time helping us get through the weeds that exist in the 6 inches between our ears. And then there's a significant amount of call to action to go do the work. And when you go do the work, you will get business and you will get an ROI. So historically, Bold has a very high ROI because it's more than a class. It's kind of like if you're going to go to the gym, having a personal trainer, right? They're going to, for lack of a better way of saying it, they're going to force activities upon you. They're going to force goals upon you, all of which, if you do them, are going to cause you to do more business. So historically, yes, Bold has a very healthy ROI when you show up and do the work. And you know as well as I do, everybody on this call knows, there are people who will show up, they will sit in class, they will enjoy the material, and they will not do the work outside of the classroom. And if that is the case, you will probably leave feeling a little better as a human being, probably having some personal growth, but it's not going to show up in dollars and cents in your business if you don't take action.
Okay, thanks.
You're welcome. Karina?
No, I was just looking at my personal occupancy. I have office fees in occupancy. Is that where that should be?
When you say office fees, do you mean like market center fees?
Yes.
So if it includes desk rental should go in there. Private office cube, anything like that should go in there. If it is, every market center is a little bit different. If
Mhm.
there's just a monthly fee that you pay and that provides a bunch of services,
Mm-hmm.
it becomes a little gray what bucket that goes into. You could argue it goes into communication and technology because part of that is your tech fee that pays for your mobile app and your CRM and your website and all the other tools that you have. Part of that could be show desk, if that's part of the services, which you could argue would go in a different bucket. Here's what's most important. If that is not rent, then I would say no, it doesn't belong in occupancy. It probably belongs in communication and technology or some other bucket. Here's what's most important, though. What's most important is that whatever you do it consistently. Right? At the end of the day, if I have $100 and I subtract $50, I have $50 left. And remember, a P&L is addition and subtraction. So your bottom line isn't going to change depending on what bucket you put it in, with some exceptions based on tax law and things like that. So for the most part, you don't have to get too wrapped around the axle, especially early, around what bucket it goes into, as long as you're consistent when you do it, right? So for those things that are sort of gray, my advice is pick the bucket that makes the most sense to you and then just do it consistently, right? If you start putting it here sometimes, now it starts to get messy and it becomes hard to really use it as a financial tool. Another example where that often happens is we went over the definition of cost of sale, an expense that only happens when you close a transaction. So a lot of times I'll get the question, well, I use a transaction coordinator and I only pay when it closes. So is that a cost of sale, or should I be putting that under salaries and benefits and a subcategory of transaction coordination? Yes and yes. Could be either one. It technically meets the definition of cost of sale if you only pay when the property closes. So technically, it could be a cost of sale. Personally, I would put it in salaries and benefits with a subcategory of transaction coordination. End of the day, is it going to change my bottom line? No. The bottom line is going to be exactly the same. So with those gray areas, my advice is, again, do what seems most logical. Check with your bookkeeper or CPA if you feel like you need to. Do what feels most logical for the gray areas, and then just do it consistently. Does that help?
Yeah, that does help because because I mean, even in salaries and benefits, I have some things in there that I'm not sure if that's where they should be, but I always put them there. So I guess that's fine.
Yeah. Yep. Consistency is what matters the most. Okay.
Okay.
A couple other terms I'm going to hit real quick. Oh, go ahead, Joe.
Is there an input area where you can day to day just input each individual thing that then feeds to this? Or do you have to just go in and update it, like from whatever, $1,000, then add that $30 expense in and increase it to that amount to keep the flow, keep this
Sure.
fluid?
Yeah, so it totally depends on what platform you're using. So what we're using to demo right now, just to have a profit and loss to look at, is the RE Profit platform, which is a software company that I own, I built, for the reason that when I was teaching business financial management, personal financial management, I always try to teach tactic tool. And this was one area where there wasn't a really simple tool to be able to offer. We have QuickBooks. It's a little more complicated than we really need. There's spreadsheets. Most of us are not wired to manually put this stuff in and do it consistently. So it led to creating the platform. This particular platform, like QuickBooks can also, connects to your bank accounts and credit cards and automatically pulls that stuff in. So all that data entry is happening automatically. Every time you do a transaction and or open the account, it's pulling those in. and populating them into the correct buckets for you. So the idea behind this platform is that it is doing that for you while you're busy doing other things. If you don't have a platform that is automated, even with RE Profit, what we always coach everybody to do is a 15-minute Financial Friday. We say Financial Friday because it sounds good. It's 2 F's. It could be Sunday, it could be Thursday, it could be Wednesday. The point is, again, consistency. If you put 15 minutes in your calendar, in this case, we're going to say Friday morning before the day takes off. So 15 minutes early Friday morning, you pour yourself a coffee, you open up whatever your profit and loss and budgeting platform is, and you spend 15 minutes. For us, we coach just a handful of things to do. You look for uncategorized transactions and categorize them, right? Because in this platform, a lot of that is automated. So you're only going to have a couple unique transactions that it didn't recognize. So whatever platform you're using, look for things that are uncategorized. We tell you to look for owner draws. So an owner draw, which is an important term to understand, an owner draw is anytime an owner takes money out of the business for personal use. Okay, an owner contribution or a capital contribution is anytime a business owner puts their own money into the business, right? So if I take $10,000 out of my personal bank account, put it into my business account, that is an owner contribution. It's not income. That's money I already made somewhere else. And I'm taking it and I'm putting it into this business. Opposite is true. If I take cash out to go use for personal use, that is an owner draw. So from an accounting standpoint, those two things don't show up in your P&L. Those two things show up on a balance sheet. Okay, in this platform, we categorize those and they show up down here so that you have a record of them, but they're not affecting the numbers inside the profit and loss. Okay, so taking money out as an owner draw, putting money in as an owner contribution. Where this becomes relevant, and some people do get a little wrapped around the axle, when we pay our taxes. When we take money out of the business and pay our taxes, that's not an expense that we get to deduct, right? Most of us are either operating as a sole proprietor, an LLC, or an S corp. In all of those scenarios, it is you personally as the owner who is paying the taxes. When the tax bill shows up and you take money out of the business to go pay that tax bill, that's an owner draw, right? So that's an example. In this platform, when you make those payments, they're going to show up down here under owner draws, right? Because it's not an actual expense. It's not going to hit the P&L. It's going to show up on a balance sheet in normal accounting, okay? What was your original question, John? Because I want to make sure I didn't forget to actually answer it.
Yeah, I was wondering, if there was a place to input it, but I see how if you're using your system, then, for example, as expenses show up on your statement, your bank statement, then it prompts you, okay, where does this go? How do you categorize this? Is that correct?
Yeah, so it's less effort than that. So on this platform, and honestly, I would strongly encourage you, unless you're one of those rare breeds that is wired to do manual accounting, and there are not many of those in our industry. Most of us are wired to talk to human beings, right? It's the opposite personality of doing bookkeeping. I would encourage you to have a platform that is highly automated. The more automated it is, the more systematized, or just pay someone else to do it.
Mm-hmm.
So in RE Profit, it's connected to the bank accounts and credit cards. While you're busy doing stuff, those transactions are being pulled in and they're automatically being categorized based on the coding that we've put in there. Also, as you use the system, it learns from the way you categorize things and it starts to recognize those unique transactions. Your stager, you categorize that as staging. The next time it shows up, it goes, oh, I remember this. This is staging. That goes here. And it's doing that stuff for you, right? So whether it's QuickBooks, RE Profit, or some other platform, if you have that level of automation, then all you really have to do when you do log in is check it. You look for any unique transactions that it didn't know what to do with. Those will be uncategorized. You categorize those quick, right? You look for owner draws. And the reason I say owner draws is one of the things we always, if you're in an automated platform, you want to make sure you're checking. Let's say you have a restaurant that's your favorite restaurant. You've been there 10 times this year, and it was you and your spouse. And that was a personal expense. But all of a sudden, you show up, you go to that same restaurant with an investor client of yours. Well, now it's a business expense, right? An automated platform might go, okay, we've seen this 10 times and it's been owner draw. Well, this time it wasn't personal, this was business. So you want to check an automated system to make sure it's not putting anything in as a personal expense when it shouldn't be a personal expense, because you'll lose the deduction. Now, that becomes irrelevant if you're doing what you should be doing, which is you have separate accounts. I have business accounts and I have personal accounts. Then you don't have that crossover. When we built RE Profit, we had to build it to be able to function if you're commingling, because unfortunately a lot of agents do. They have one account and they operate personally and professionally out of the same accounts. RE Profit will pull out all those personal transactions and bucket them as owner draws so that you have a clean P&L. The right answer, though, is you have separate accounts. Everything that happens in this account is business. Everything that happens in this account is personal, right? It's like a mullet. How's that go? Business in the front, party in the back. So you want to have them separate. If you're not doing that, number one, you should. Another nugget around that, if you are commingling, stop and don't overthink it. In some states, in order to open a business account, you need an EIN, and maybe you're like, I don't have an LLC. We're making it too complicated. Go to the bank, open a checking account, a savings account, nickname them business, and you're good to go. Don't overcomplicate it, right? The whole key is to have things separate, right? Another thing to hit on, and then Alan, I see your hand up. Another place where we often have a run into a lot of commingling, maybe you have rental properties, maybe you do some property management, maybe you flip houses, right? We run into that a lot. A lot of us do those other things that are real estate related, but not real estate sales. It is my humble opinion that you should keep those things separate from an accounting standpoint. Because the problem is you start mushing all those things together and it blurs all the numbers. So now I'm looking at my profit and loss. Maybe my goal was to do 10 million. I'm looking at my revenue and my revenue's on track for the year, except 50,000 or 100,000 of that revenue did not come from sales. It came from a flip I did. Well, now it's hiding the fact that I'm behind on my revenue, right? So you want to keep those things separate. Even rental properties, for me, every rental property I have, the money flows into a single set of books, but everything is coded so that I can pull a report and look at every property separate. Why? All combined, it might look like they're doing really well. And because I can't separate them, I might not notice that there's a dog in there that's dragging profits down. Whereas if I can separate those out, now I have clarity and I can go, wait a minute, these properties are doing great, but this one is costing me money. That's one I'm either going to figure out why and fix it, or I'm going to get rid of it and reinvest into something that'll make me money. If I put it all in one lump, the water just gets muddy and I can't see. So in all businesses, you want to try to keep things as separate as you can. A, number one, separate your personal. And B, if you have multiple revenue streams, at a minimum, categorize them. If they're flowing into one set of books, categorize them so that you can look at them separately, right? So if it's RE Profit, QuickBooks, whatever, if you are going to have those other revenue streams that are non-sales flowing into the P&L, at least create subcategories for them that are income, rehab and resell, or income rental property, so that I have means of looking at it separate, right? Otherwise it gets blurred and I can't make business decisions. Alan.
I just want to emphasize everything that Matt just said in terms of great advice. And also, I just want to mention in terms of the theme of separateness, I also encourage people to have a separate business credit card versus personal credit card. And for actually two reasons. One is It's going to be easier for whatever platform you're using if we know that the Costco card is all business and the JetBlue card is all personal. The flow, the auto flow of those charges into a P&L, into a platform is going to be a lot easier. And the second thing is a friend of ours, Matt and mine, did this at a session, a mastermind session, and every year he changes his business credit card number, calls the credit card company and just asks them to change the number. Doesn't affect anything, just changing the number like a stolen card. And what that does is that puts everything that's auto pay on the table for evaluation at that point in time automatically. And so that's another benefit of having a separate credit card for business, just like you have a separate checking account. So great advice. Thank you, Matt.
I had an agent who did that after getting that advice, and they discovered that they were paying for 3 gyms and they were not working out. They had 3 gym memberships and we're not using any of them, right? The one we usually hear when you do something like that is you find out you have multiple Netflix accounts or Disney Plus accounts. Why? Well, I pay over here and it comes with this, but then I'm paying for it separately. But the idea is if you shut everything off once a year, now all of a sudden, right, you see everything has to be re-inputted and you recognize that's also why, right, we always say what you focus on expands. If you spend 15 minutes a week, which is nothing, right, again, early in the morning, go into your P&L, you do the few things you have to do to make sure everything's categorized, spend a little time with it. What you focus on expands. You're going to start to notice things. You're going to start to recognize where there's wasted money or where there's opportunity, right? You're going to start to look at your ROI report, which you do have inside of RE Profit, and you're going to look at what's working, what's not, right? There is a company that rhymes with pillow that changed their business model a few years back, right? They went to a referral-based model rather than a zip code marketing-based model. However, when they did that, they didn't get rid of the old model. They just created another model. Now, by the way, there were no more human beings selling houses and buying houses. It was the same amount of homes, buyers and sellers available. They were now just being sold to real estate agents in 2 different ways, which just means every lead was being sold more times. When that model changed, we started to see it in the RE Profit ROI reports. We started to see the ROI on that particular platform diminishing for those individuals who were on the old model. Why? Because they changed their business model. And when they did, it negatively affected some of the individuals who were on the old platform. And it started showing up in the numbers. People started looking up and going, wait a minute, my ROI used to be this, now it's this. I've got to take a closer look at this and make a change, right? Those are the things that you identify when you have this tracking in place. And if you have something that makes it simple and automated, you don't have to put a ton of thought into it. The time you spend with it is really understanding it, right? And it was my coach who said to me I've had the same coach for, 16 years now. And he told me early on that first you have to have a P&L, and then over time you learn how to read it. And once you learn how to read it, eventually you learn how to write it. And what he meant by that was you eventually understand it at such a level that you know how to make it say what you want it to say. In other words, I decide what my profit is going to be, and I know how to use it as a tool to ensure that that profit shows up at the end of the year because I understand the math and I know how to reverse engineer it, right? So it's first you have to have it, then you learn to read it, then you learn to write it. Michelle?
I understand the importance of having separate credit cards for business versus personal, but how important, or is it important to have that business credit card in the business name, or does it not matter?
So it depends. Depends on how you're structured. If you are structured as an LLC or an LLC that files as an S corp, if you are structured as an entity, then I would say it's important. If you are operating as a sole proprietor, then in a perfect world, yes, it's under the business, but it's not really that important. What's more important is that it is separate so that you can manage it and so that you have transparency, which, by the way, on the personal side, we should all have the same tools on the personal side. We should have a profit and loss for our household so that we know where the money is going. It's not complicated, right? Once you get these things and you put them in place, there's apps for the personal side. I used to recommend Mint. Unfortunately, they shut down. I wish I had a good recommendation. All I can say is Google it. Mint, I had personal experience with, and it was very good. And I recommended it for years. I don't have any personal experience with the apps that are out there now, but if you Google them, just Google personal financial management apps. There's all sorts of apps out there. I just can't speak to how good they are because I've never used any of the ones that are out there now. But there are simple, inexpensive tools out there that allow you to have the same level of organization and transparency on the personal side, right? And you don't have to spend a lot of time. Technology has made these things much easier to do and much easier to understand. I think somebody else had a hand up. I thought I saw a hand go up.
Yes, I do. One last question.
Sure.
What makes it secure, that your system, because that's always an important thing if you have your accounts tied to it. What is, the entity that's securing this?
Sure. So the way this platform and any financial platform works is there is I'm going to say middleman. Forget the gender. That's a gender neutral statement in this situation. But there's a company in the middle that actually handles the transfer of data from any financial institution to any platform like QuickBooks or RE Profit. So that particular company that we use for RE Profit is called Finicity. They're one of the largest. A platform like QuickBooks, Quicken, RE Profit, any of those platforms, the only thing the platform has is numbers and decimals. Everything else is housed elsewhere. Your bank has your passwords and all that stuff. And there's a thing called the security token, right? So any company that has a connection through what you call an API, right? Think of an API as just a straw, right? That you can suck the information, meaning the numbers, from the institution to a platform. That's an API. Any platform that connects to any financial institution, bank account, credit card, any of those things, they have what's called security tokens. So the company has to go through security checks in order to get an API connection. Once you do that and you connect the account, your banking institution gives that platform a security token, which basically says, okay, when you request information, we will send you the information. But any platform, again, regardless of what it is, that does something similar to this, they don't have your username and passwords. They don't have access to your bank accounts. They don't have any of that. All they have is numbers and decimals that get transferred through an API. So that's where the security lives. It's between the bank and the institution, in between the bank and the platform. And there's a tremendous amount of security that goes on around all that.
Okay, thank you. Awesome.
You're welcome.
I assumed it would be, but I wanted to hear. So,
all right. Very quickly, not a sales pitch at all. I'm going to put a QR code up for you. If you would like to get a demo of RE Profit, you can scan that, schedule a 15-minute demo. I want to be super clear. This is not a sales pitch. I'm obviously biased. I built the platform. I own the platform, and it's irrelevant to me what platform you use. As long as it's something that works for you, you use it consistently. And I would encourage whatever you use, it should be automated. You're either paying a bookkeeper to do the vast majority, or it's a platform that has heavy automation so that you're not spending a lot of time, right? It's not about inputting the data. It's about having the data, right? So the less time you have to spend on it, the more likely that you're going to consistently engage with it. Right? So either bring in a bookkeeper who can do it for you or have a platform. that is heavily automated so that the time you spend on it is more looking at it and making business decisions than it is inputting data. Make sense?
Matt, I'm just gonna add that RE Profit is set up based on the MREA's chart of accounts. So that is one slight difference. In a lot of other platforms will not have that advantage.
Correct. It is going to give you, it's based on the Millionaire Real Estate Agent chart of accounts. It is going to give you your budgets. You just select your production, and it tracks all the other things we talked about. It does track your ROI on marketing and lead gen. It tracks your cost of sale, all of those other things. So it was designed to be as simple as it could be, give you what you need to file taxes, but more importantly, give you what you need to maximize the profit in your business by tracking the important metrics. So the thing I want to encourage you, right? End of the day, like think about houses. We sell houses. I would argue the most important part of the house is the foundation. You can build the most beautiful house. If you build it on a shaky foundation, then the home becomes worthless, right? Because it is not structurally sound. In business, profit and loss and budget is the foundation. It's that and your lead generation strategies is what makes your business stable, right? So whatever platform you use, just get something in place to make sure that you have that foundation so that everything you're building, you know, is built on something sound.